Hi, everyone. I want to welcome you all on behalf of ALPFA Boston and our Gold Corporate Partner Fidelity Investments to our webinar today, Smart Investment Move. I'm just gonna give you a couple of minutes for people to log into the room. In the meantime, while we wait, if you wanna share on the chat, where are you connecting from and basically what brought you here, that'll be great. So let's just wait a couple of minutes till like everybody tune in. So for people who is just logging in the meantime, if you can just like put in the chat, where are you connecting from and what brought you here? It will be great just to know a little bit more about the audience today. Hi, Eileen, greetings from Boston. I'm also connecting from Boston. Pretty nice day outside today. Hoping it's gonna be the rest, like for the rest of the weekend, it's gonna be like this as well. Perfect. So just for the sake of time, I think we can start just to make sure we are in compliance with the agenda. So firstly, let me just introduce myself. I'm Natalie Calabrasimo. I'm the director of the Financial Literacy Committee at ALPFA Boston. I've been part of ALPFA for the past almost like 4 years, and I'm pretty excited to be here today to open this event we have organized for you. So for those who are fairly new to ALPFA, just to give a little context, we are the first National Latino Professional Association in the United States, established in Los Angeles back in 1972. We have our Boston chapter established in 2000, and we are a national nonprofit membership organization for Latino entrepreneurs, professionals, and students. So ALPFA is dedicated to enhancing opportunities for Latinos in business and entrepreneurial pursuits and creating more diversity in corporate America. Our mission is basically to empower and develop the Latinx individuals as leaders of character for the nation in every sector of the global economy. So our agenda for today, basically we just started like at 12:30. The event is intended to be until 1:30 p.m. We're just having the opening remarks. We're gonna have a presentation by Monica Mantilla, Lisbeth Menjivar, and Marco Gargurbich, and then we're gonna have a short Q&A, like a couple of minutes of Q&A, and then the closing remarks. So if you have any questions, please feel free to post them in the chat. The speakers are gonna go through them as we go on, like towards the end. So basically, we put this event together because we believe in ALPFA, and I'm sure Fidelity shares the same thought that financial literacy is critical because it basically gives us the knowledge and skills we need in order to make informed decisions regarding how to manage our money. So we know, like, money and finances impacts almost every aspect of our life, but not enough people know at least enough about it. So basically, we are here today to provide you with tools and knowledge about investing directly from our experts from Fidelity, who will be sharing their expertise and basically like best practices, like instruments available, alternative we have, and much more. So please stay tuned. And again, please post your questions in the chat. We're gonna go over them towards the end. So just to leave the panel to the experts, we have here today with us, Monica Mantilla. She's an investment consultant from Fidelity Investments. She is an immigrant. She just lived in Honduras, and Nicaragua and Mexico. So she's gonna give you a little bit more details about her career in just a couple of seconds. We also have here Lisbeth Menjivar. She is a planning consultant also from Fidelity Investments. and she is from Illinois, I believe. She's currently in San Diego, so she's gonna give you also more details about that. And we have, last but not least, Marco. I won't pronounce your last name just because I did it great first time, so I don't want to mess it up this time. And he is right now the head of strategic initiative at Geode Capital Management LLC. So I'll leave the floor up to you guys, so you can start from here.
Excellent, wonderful. Thank you very much. So let me share our presentation, which we prepared for all of you today. So welcome to Money Conversations with Fidelity. Thank you for the introduction, Natalie. My name is Marco Gargurvich, and I'm with Geode Capital Management, which is a company that was started by Fidelity. Geode specializes in asset management for passive investing. That's index funds and exchange traded funds, which we will get into in our presentation today. So I want to thank Natalie and Laura from ALPFA for inviting us to speak at your event. It would be wonderful to be there in person. In the past, I've participated in live events at Boston University, at Fidelity, and those are always fun to engage with associates. But given the virtual environment, Zoom is quite helpful for us. Today, I'm joined by my Fidelity colleagues, Elizabeth Menjivar and Monica Mantilla. We're here to talk about how investing can fit into your life. Before we get going, let me tell you a little bit more about my personal profile, my career. So at Geode, I'm head of Geode Strategic Initiatives. I work on the top projects, the top strategic initiatives that benefit our clients and our business partners. So as an example, in my role, I partner with my Fidelity counterparts to collaborate and launch new products. Our area of focus, as I mentioned before, is passive investing, where we work as a sub-advisor to Fidelity on some of our index funds and exchange traded funds. But one of the things that I'm most passionate about is about tearing down that perception that investing is only for professionals or it's for people who are highly seasoned. You know, the truth is investing is for everyone. And I'm proud to work for a company that is really focused on paving the way for accessibility for all. So now let me turn it over to some of my colleagues. Lisbeth, I'll start with you. Please tell us a little bit about yourself and your role at Fidelity.
Thank you, Marco. Hi, everyone. My name is Elizabeth Menjivar. I'm a planning consultant with Fidelity Investments in the Orland Park branch office. In my role, I help clients and their families develop, implement, and maintain customized financial plans to achieve their financial goals. But my passion really lies in educating and empowering youth to learn to build financial wealth. My hope is that with increased financial capabilities, more people in our community will be able to transition from surviving to thriving. Financial literacy is important because it allows an individual to understand and maximize whatever level of income they earn. It helps people transform their lives. That's why we do it. That's why it's important. And that's why I'm here today. So thank you.
So Monica, why don't you tell us about yourself?
Wonderful. Thank you, Marco. Hi, everyone. Thank you for joining us. I am Monica Mantilla. I'm an investment consultant with Fidelity. I'm tuning in all the way from San Diego, California, but super excited to be here and be part of this conversation. In my role, I help clients like all of you joining us plan for retirement, invest, and really leverage all of the resources that are available for you. I'm really excited to be part of this conversation and really break down the perception that investing is too difficult and out of reach. And I'm hoping that this conversation today will help you walk away feeling more empowered when it comes to your money. So thank you for having us.
All right, so let's get to it. This workshop is part of a series built around what we call the 5 money musts. these are 5 core money concepts, which you see outlined here. So number 1 is creating a budget that works for you and keeps you on track, right? You need to be in control of your money first and be able to get through each month before you can be thinking about long-term and investing, but it doesn't have to be that elaborate. Number 2 is taking care of your credit health, which is all about your credit history, your credit score. We see a lot of commercials about that, and your ability to borrow money, okay? Number 3 is managing and paying off debt in a smart and thoughtful way, right? This is very important because these 3 first steps are the foundation to establish financial health. And it's once you've got these things under control that you can really start to focus on investment and longer term planning. So number 4, which will be our focus for today, is investing to help you meet your money goals. And finally, the target here is starting to plan for retirement early so you could take care of the time that you have ahead of you. So today we'll focus on investing, which includes investing for retirement and how it can factor into your overall financial health and wellness. So let's get started. At its very core, investing seems really inaccessible to people who've never done it before. I know it was like that for me when I was getting started. It can sound overcomplicated. Some of these financial terms are very complex initially until you really start getting into it. But really, honestly, Lizbeth, why is that? What gives here?
Well, you're right. The financial jargon our industry uses can make investing in the stock market and saving for retirement seem like complicated and even scary topics. That's not your imagination. Terms like volatility, asset allocation can cause confusion and even create fear. But here's the secret. Investing doesn't have to be overwhelming. There are ways for you to invest that may help you minimize your risk while still helping you reach your goal in the long haul. Excuse me, everyone. And though it might be a long time away from some of us joining today, one of the easiest ways to start investing is by putting money into a retirement account, whether that's at work or in an account that you open up on your own. Some small steps today can help you put yourself in a better financial path for the rest of your life. The graph that we're going to show here actually shows the history in the past 35 years or so. Even with steep drops in the market, it has historically continued to climb.
Yeah, these points may help you reframe your fears about investing, because if you look over the past 35 years, you'll see that there are ups and downs, but generally there's an upward climb for investing. What else do people need to know before we dive into the how-tos of investing?
Well, there are a couple of key financial concepts we should go over first. In order to understand how money can grow over time, you need to know about the beauty of compounding. Here's an easy way to think about it. If you ever made a loaf of bread from scratch, you've seen how something can grow exponentially. The yeast goes through a reaction causing the dough to rise and expand. Compound interest works in a similar way. When you save money, you earn interest. When you invest it, you might make gains or earn dividends. I'm so sorry, guys. I have something in my throat and I'm trying to work through it. In both cases, if you leave the interest, dividends, and gains in your account, you'll be added to your principal, which is the amount you originally had in the account. If you earn interest or additional gains on gains, they'll be added to the combined balance. So your interest even ends up making interest.
Yeah, and most of us have probably seen the other side of compounding, such as when you use a credit card, right? If you pay off minimums on a credit card, it continues to grow, right? So your debt grows in a credit card, and that's the other side of compound interest.
You nailed it, but we'll save the topic of debt for another workshop. Luckily, that same process that makes your credit card companies happy works in your favor when you save or invest.
Yeah, so that's a great point. So speaking of saving or investing, I think that's another place where people can sometimes get tripped up. Monica, can you talk a little bit about how they're similar and how they're different?
Yes, the terms do get mixed up sometimes, and they're both important tools that can and do work well together to help you reach your financial goals. So you don't have to choose between them. So let's start with probably what's most familiar and comfortable, and that's saving. It just means you're gradually putting money away into a bank account or any other type of short-term savings account, maybe even under your mattress, although we hope so. We hope not. The different types of vehicles, there are different types of vehicles that help you stash your money away for short-term goals and bills, spending cash, plus your emergency fund. So that's the saving portion. Investing is a little bit different. It also starts by putting money aside, but this time your money is going into an account like a workplace savings plan, such as a 401k, 403b, or an individual brokerage account. You then buy investments like stocks, mutual funds, or exchange traded funds, ETFs, which is important to keep in mind. You can't just deposit money and hope it will be invested. You actively need to select your investments. This doesn't mean actively picking investments often. Like we mentioned, active trading earlier. This just means choosing investments to start off with and then reviewing your portfolio often going forward, maybe once a year, to make sure that your investments are still in line with your goals. As a tool, investing is used to meet your medium and long-term goals. When you invest, you're making a plan for your future and focusing on potential returns in the future and creating wealth. And with anything that has the potential growth with time, the sooner you start investing, the better chance that you may have for reaching your financial goals. To be clear, the longer term investing we're talking about today is different than the active trading you see in movies. Actively trading is an advanced practice of buying and selling securities like stocks, bonds, mutual funds, etc., in a short time frame. This can be tricky and very risky, so it requires much more time, research, checking on your investments often, even daily. So investing for the long term means you have more time to weather that volatility or the ups and downs of the market we saw earlier. So it actually works in your favor to check in less, since we'll be less tempted to make those knee-jerk reactions or short-term changes that could impact our strategy for the future. Now, unlike traditional bank savings, there's risk involved when we invest. There's always the risk that the market can go down and your account can go down in value. But there are some ways that we can help lessen your risk, like diversifying, which we'll touch on that in a few minutes.
Yeah, so these are important distinctions. Turning back to Lisbeth, earlier you mentioned starting small. How can someone who's never invested take that first step?
Well, first, let me start by busting a big misconception. You do not need a lot of money to start investing. And if you have a 401k, 403b, or any other type of retirement account, you're already an investor. So how do you start? Well, first, think about how long you have to reach your goals, your financial needs, how much risk you're comfortable with. Are you investing for the future or saving for something that's just a year or two away? The time you have may impact the level of risk you're willing to take, the type of account you choose. For instance, if you're saving for retirement, there are tax advantage accounts that may help your money grow, tax deferred, or even federally tax free. Then you need to decide what your investment mix should be. This is also called asset allocation, and it's just a fancy word of way of saying what you're invested in. At Fidelity, we believe a blend of different types of investments may help you balance risk and reward. And that may mean a mix of individual stocks, individual bonds, mutual funds, short-term investments, long-term investments, or whatever. What's important is that you diversify your investments, which means spending your money with different investment types, different companies, industries, countries, and business sizes. In other words, don't put all your eggs in one basket. The information isn't something that you should know automatically. There are guidelines that may help you figure out what suitable level of risk, return potential for your situation. For example, if your goal is further away, you are able to take on more risk and most of your money can go on stocks. A financial provider like Fidelity can help you determine your proper asset allocation. You can find tools on our website, which we'll share at the end.
Yeah, and what Liz is sharing is so important to keep in mind, because regardless of how you intend to invest, there are different steps that you can take to lessen your risk. So with this in mind, if you feel comfortable investing yourself, you can reach out to a firm that handles your workplace retirement plan, or look for a brokerage company like Fidelity. But it's important to know that not all brokerage firms are the same. So do your research before working with any person or institution. Financial firms provide access to different account types, different levels of education, research, costs, and fees that can vary across all providers. So do your research while selecting your firm. But if you are someone who wants help managing their money, you can sign up for things like a robo-advisor, which can help manage your investments and also pick the appropriate asset allocation or mix of investments that Liz was talking about, usually for a smaller fee. Or you could go with a financial advisor if you want more of a one-on-one relationship, which usually will cost a little bit more, but it depends on your situation and what you're looking for.
All right. So we now know what's important, that it's important to have a variety of investments, from stocks to bonds to funds. Can you explain a little bit more about what each of these categories are?
Yeah, so I'll take a couple of those, Marco. Let's start with bonds. Bonds are on the lower end of the risk spectrum, so they take time to make you money. They're better for longer term investing needs. When you buy a bond, you're lending the issuer. So for instance, a company or the government, you're lending them money. And how that money is paid back to you, it's determined by the conditions in which you bought the bond. And on the other hand, when you buy a stock, you're buying a piece of a company. And how that company performs will determine the value of that, if that stock goes up or goes down. And since we can't predict, nor should we ever try to time the stock market, risk is involved. So stocks, also called equities, have potentially less inflation risk and are the highest potential, on the highest risk, and also on the highest return spectrum. So this is typically what most people are most familiar with when they think about the stock market.
So what about funds like mutual funds or exchange traded funds, which we call ETFs? Elizabeth.
So I recently heard an analogy that can actually help people understand mutual funds simply. Just say that a mutual fund is like a chicken burrito. You have chunks of chicken, piles of rice and beans, slices of jalapeno, globs of guacamole, a sprinkle of cheese, and a drizzle of sour cream, all wrapped in a soft tortilla. A mutual fund is made in a similar way, but imagine that chicken, beans, and everything else are stocks, bonds, and other investment types. The cook is like a portfolio manager who wraps all the ingredients in a blanket. That blanket is the mutual fund. And if you take a bite, you get a little bit of every ingredient. And that one bite is just like one share of mutual funds. An ETF is very similar in that when you buy a share, you're actually buying small percentages of a lot of different things. So both mutual funds and ETFs are essentially baskets of securities with different strategies or themes. And both can either be actively managed by a portfolio manager or passively managed by a set formula. For instance, both could be built to follow what's called an index, such as the S&P 500, which you may hear about in the news as an indicator of the health of the economy. But sticking with our food metaphor, if a mutual fund is like a burrito, let's say an EFT is like a quesadilla. What's inside it might be similar, chicken, cheese, beans, guacamole, but the way it's built is different.
Okay, yeah, it must be lunchtime because I'm getting hungry, but I've never heard it explained quite like that. So what are the differences we should keep in mind?
Well, one major difference is that mutual funds are only priced at the end of the trading day. So if you try to buy mutual funds in the morning or afternoon, the price you'll actually pay won't be determined until the end of the day. ETFs, on the other hand, can be bought and sold anytime. So the market price you see at the time of the trade will be the one you buy it or sell it at. Another difference that affects investors is that mutual funds have historically been more costly to manage. So they tend to cost a little more to own in fees. ETFs, on the other hand, have historically cost less to own. Of course, the industry changes all the time, and there are mutual funds on the market today with really low cost. So you definitely want to do your research before deciding. Finally, capital gain taxes or taxes that you pay on gains from your investments tend to be lower for ETFs because of the way that they're structured. One last thing here, since mutual funds and ETFs are either made up or track different securities like stocks and bonds, their level of risk can vary depending on what's included or tracked. If your mutual fund or ETF involves lower risk securities, it will be lower risk. If it involves higher risk securities, it will be higher risk. In other words, a burrito or a quesadilla with extra jalapeno is going to pack some heat, no matter how it's wrapped. You'll understand what investments make up the fund before deciding to invest.
Very
So,
good.
yeah, understanding, I think I definitely agree with Liz and understanding what all these are. Here are some of the examples of different allocations or just a mix of types of investments in your portfolio you might consider as you're determining the level of risk that you feel comfortable with and how long you plan to invest when it comes specifically for a retirement goal. But even though these are examples for retirement, remember that different asset mixes can be for any of your long-term investment goals. When you're further away from retirement, you may feel comfortable taking a little bit more investment risk because you probably have more time to ride out the ups and downs in the market. For example, your investment mix could include more stocks, which would make up a more aggressive portfolio than what we see on the left, and for your money to allow it to grow over time. And as you get closer to retirement and closer to when we'll need access to the money, you may choose to shift your investments to become more conservative or less risky and adjust your portfolio to include more bonds and short-term investments to really give you that more conservative allocation. If you'd rather not worry about making all these changes manually all the time, you may want to look into something that's called a target date fund, which adjust your investment mix automatically over time based on that target date of your retirement goal.
Great, that was really helpful. So shifting gears a little bit, or maybe shifting gears a lot, let's talk retirement specifically. Give me 1 second here. Technical difficulties as I'm clicking through. I want to get into 401ks and 403bs. You know, that's a lot to take in. IRAs. Can you break that down, what these different products are?
Yeah, well, there are many different investment accounts that can help you save for retirement. Some are sponsored by your employer, such as a 401k, 403b, 457. With these plans, your contributions come out right out of your paycheck before you pay taxes on them. So for some employers then offer a certain percentage match on those contributions. And because they're tax deferred, your money can benefit from that compound growth we talked about earlier. And the difference between these types of accounts that has to do with the employer you have and what type of plan they chose to offer to you. Most private companies offer a 401k plan. You might be familiar with those, while the 403b and 457 plans are offered by most public or nonprofit employers like public schools, hospitals, private nonprofits, and the states. With these types of accounts, the employer provides a variety of funds or individual securities for us to invest in that you can choose to manage the investments on your own and select on your own. Many times this will include what's called, again, a target date fund, which you could pick based on your expected retirement date. When you're young, the investments in this type of account would be more aggressive. And as you move closer to retirement, your allocation or mix would automatically shift to a more conservative investment. Remember, if your employer offers a match, most financial experts suggest contributing at least the amount that they match so that you don't leave any free money on the table. For example, let's say that your company matches 100% of what you contribute up to 3% of your income. So even if you only contribute the 3%, the match will effectively double that amount to 6%. So that's pretty much free money. So don't leave that on the table. There are also other types of individual retirement accounts called IRAs. These are accounts that you open up on your own to save towards retirement and are not associated with an employer. Two in particular that we may be familiar with or heard of are the traditional IRA and the Roth IRA. Unlike the workplace options sponsored by your employer, contributing to an IRA are generally made after tax. So with the traditional IRA, the money you put away can be tax deductible and has the potential to grow tax deferred until retirement. Eventually, you'll be required to pay taxes on the money you withdraw in retirement. And if you withdraw the money before 59 and a half, you'll have to pay taxes and a penalty. So it's important to be familiar with the rules of these accounts. With Roth IRAs, however, on the other side, you invest your after-tax money and it may grow tax-free in your account as long as certain requirements are met. So a big difference between the traditional and the Roth IRA is that the Roth, you can take your contributions anytime for any reason, tax-free and penalty-free. So that's your contributions. And you can definitely learn a little bit more about these accounts by visiting our Fidelity site, searching on the upper right corner. It'll break it down step by step what the difference between the two.
Fantastic.
Yeah, and I think one more point about retirement, since we are in the topic of retirement accounts. Remember the topic we talked on earlier around compounding. Well, investing early for retirement is really where you can see the benefits of compounding come to life. So let's look at some examples of two people saving towards retirement. We'll call them Emma and Jason. This is Emma, what we're seeing here. She's 35 years old and is contributing $5,000 per year to an IRA or individual retirement plan. Assuming her savings compound at a 7% rate of return, she could potentially have almost close to $800,000 by the time she's 70 years old. Now, let's take a look at Jason. Jason is 25. And he attended one of these meetings, so he understands now the power of compound interest. And he's also contributing $5,000 a year to his IRA and his retirement plan. Assuming his savings is compounding at the same rate as Emma, 7%, he's able to grow his saving closer to $1.6 million. As you can see, Jason started saving early, so he had more time to benefit from that power of compound interest, allowing his savings to grow to almost double Emma's. So time is really our friend, and when it comes to compounding.
Great. That's a perfect example. So to wrap up, saving and investing are both important parts of reaching your financial goals. Contributing small amounts over time could lead to a big impact. The right combination of stocks and bonds and cash can help you match your goals. And a retirement account is an easy way to start investing today. Always make sure that your funds are invested properly according to your goals and your timeline. So any final words of wisdom before we move into our Q&A section? Monica.
I think that I can remember starting in the industry and people talking about planning for retirement, and it seems so far away. So I understand it can be difficult to see the long time horizon, but the longer time we have and the sooner we start, even with just a small portion, start investing, the most benefit you'll earn in the long term. Because and you can even use retirement calculators online and really play with the numbers and see the difference between you starting now versus 5 years versus 10 years down the line. And you'll really be shocked and hopefully encouraged to take action sooner than later.
Okay. So Lisbeth?
Let me add one. Although investing can seem intimidating and considering more aggressive investment might seem a little bit risky, investing too conservatively for long-term goals can carry its own risk. You run the risk of not keeping up with inflation, which means you lose buying power since your money will not be worth what it once was. And investing is nothing like the movies. It's not about timing the market. It's about the amount of time you're in the market. So forget about whatever Hollywood says. Time in the market is the magic.
Yeah, we saw that in the examples. So lots of disclaimers, investing involves risk and including the risk of loss, right? So that's important. So that was terrific. I know investing is a loaded topic and there's so many layers to it, but that was an awesome overview. I hope that our viewers participating today can walk away feeling a little bit more empowered, a little bit more informed than they were an hour ago. And since we're all remote, we're going to use the chat function to bring up some questions that may have come in throughout the conversation. So let me take a quick look and see what we've got in store. Okay, so there are a couple of questions on here. So Iberto Palaris has a question. If you want to retire at 65 with $1 million, how much money should I put in my retirement account monthly over the next 35 years? So he has a great situation here, right? He wants to know, what is the calculation to get there with compound interest? Does anybody want to jump into that? Maybe Monica, since you brought up the topic of retirement calculators.
Yes, so I think there are some tools and growth calculators you can find online to plug in these numbers and really see, assuming a specific rate of return, you'd have to include the rate of return to calculate that monthly amount that you'd have to invest. So you're able to use some assumptions to really get you to that magic number that you should be aiming for. So I would encourage
and I know the example. Yeah, the example that we had showed that starting at 25 with a goal of retiring at 65 over the span of 30 years, we showed that investing $5,000 per year, is that right? Was that the estimate?
Yeah, per year.
5,000 per year at a 7% rate of return over 35 years brought you to $1.6 million, right? So if we're thinking about Iberto's question, where he's saying he wants to retire at 65 with a goal of $1 million, right? He's probably closer on the end of maybe less than 5,000, perhaps 3,000 or 4,000. So the retirement calculator allows you to just plug in those parameters and see what your money can do for you over that long period of time. Okay, the next question from Isis is, what advice do you have for folks who already have these investments, but also have some extra cash, which they want to put to work to create some additional residual income?
I would say if you have additional income that you want to put into another account, you can always open up an individual account. It's always going to be based on your long-term goals, right? And your particular situation and what you're hoping to accomplish. So starting with like a robo-advisor or even going into fidelity.com or any other institution can help you with that. You can do a lot of research. You can see what best works for you. You can talk to an advisor like myself or Monica. So I would say that those are your starting points.
Okay. And Isis had a follow-up question, which was, if you have several 401k balances from different employers, is it best to combine them into one at the most current employer if allowed, or should you keep them separate?
Yeah, each employer plan, there are some options and things you have to consider before rolling those funds over. So I would encourage you to talk with the institution that holds one of the plans, or decide where you'd like to roll it over first, and do a little bit more research of what it would mean for you to leave the 401k, because there are some pros and cons. So this can get tricky because we don't want to give individual advice without understanding your situation. So I would encourage you to do some research around the pros and cons. I know Fidelity has a great article about why you may want to and why you may not.
Mm-hmm. All right, fantastic, thank you. So Rachel,
so let me just throw in one last little bit on that. So if you go to fidelity.com and you put in the search box 4 reasons to consolidate, you'll get a really nice 3-minute read viewpoint article that might help you, Isis.
Thank you very much, Liz. All right, so Rachel has a question. Would you advise investing in a Roth IRA prior to paying off student loans?
That again would depend on the individual situation, depending on the interest rate of the student loans, depending on, again, what you could get in the Roth IRA instead. You have to do a cost benefit analysis to see both. We think you can pay off debt and invest as well, but each situation is different. So we'd have to see the interest rate on the loans versus the opportunity cost or what you would see in an IRA.
Yeah, but there was one benefit that you had mentioned earlier, and that was the notion of company match, right? So, considering that in some situations, that might be the right way to go, to focus on student loans to get that resolved. But you do run the risk of foregoing company match opportunities. So that's part of that conversation. Okay. Lucid has a question. If one company does not offer a match, is there a reason why they should contribute to their 401k versus an individual IRA?
I mean, again, we're going to go back to it's an individual preference, right? Even if they are not matching, you're still saving for your retirement. So it's a way to get started. You can start and you also have to take into consideration how much you earn, right? You get some benefits from, tax benefits from investing into a 401k, regardless of whether you get matched or not. I would also say it's a way to, be committed to actually, saving for retirement, as opposed to saying, I'm going to open up an individual account, and, you never do. So again, entirely up to you.
I think another key difference there too, I agree with Liz. It's also the contribution, maximum allowed contributions for each one is different. So the 401k as of this year, the max you can contribute if you're under 50 is $19,500 versus an IRA, it's $6,000 if you're under 60. So if you plan on contributing more than that $6,000, then the 401k would allow you more leeway to add more funds versus the IRA. So that could be a starting point to think if it makes sense or not.
Okay. All right, so Christina writes in that she's actually been thinking about opening a Roth IRA through Fidelity. What are her next steps?
You can go on to fidelity.com. You can actually, it takes about 2 to 3 minutes to open up the account. You'll get a lot of valuable information from there. I'll take you step by step. And if you have any questions, you can always either use the chat in the website or you can call the 800 number.
Very helpful. Rosario writes, can I have different 401k plans in different companies? For example, if I work 1 year in a company and get the plan there, but after a year I move to a different company, can I have 2 401ks?
Yes, and that ends up happening quite a bit. We switch jobs and we leave our 401ks behind. So you can, the answer is you can have multiple, but you'd have to look and see what makes most sense for you. Because you also have the option most times to roll that into your new plan or into an IRA. So if you feel comfortable having them at different places, maybe that works for you, but then you can also combine them into your new plan or into an IRA.
Right. So let me see here. Oh, we have another question. Okay, so are there benefits to splitting contributions into both traditional and Roth IRAs, or do folks just usually stick with one?
So I would say there is the benefit. So the way that the Roth IRA works is everything gets after tax, as opposed to the traditional IRA or a 401k, everything is pre-tax. With the Roth IRA, if you leave it there for longer than 5 years and you start taking it after you're 59 and a half, it's going to be tax-free as well, any earnings or growth that you get. So if it's in your plan, and again, going back to your long-term goals, yes, there would be benefit. You'll get it, tax deferred, and you wouldn't have to pay taxes when you are retired. So that's something to consider as well.
Mhm.
And to add to that also, there are some certain limitations as far as your income for you to contribute to a Roth IRA versus traditional. So you'd want to look on the IRS website, your eligibility to contribute to both of these.
That is fantastic. Okay, I think we do have some more. Isis is back again. Thank you, Isis. So for those with significant student loans, should we pay them off early or just pay the minimum payments on the student loan until forever?
That depends. I would
Oh.
say it depends on the interest that you're paying on the loan and your situation.
Mhm. Yeah, Lisbeth?
No, I was going to say the same thing, Isis. Really, you have to look into your financials. You can sit down with a planner to go over that as well, but it really depends on where you're at, what your interest is. Does it benefit you to pay it off a little bit earlier? Does it benefit you to pay maybe a little bit of increase? I will say, though, that if you pay your student loans a little bit faster than the intended date, you're going to save yourself money because you're not going to pay so much interest. So that's another point to consider.
Okay. And then Heather asks, what if someone is planning to retire before 60? I heard about early withdrawal penalties. What kind of retirement strategy do you recommend there?
Yeah, there's something called asset allocation, as we learned today. Then there's also something called asset location, and that's referring to the different types of accounts that you can use to save towards retirement. So the IRAs, the retirement accounts, 401ks usually have that 59.5 years old rule, but there are other accounts like an investment brokerage account that there are no time limits or there are any restrictions as far as when you can draw the funds. So then you can think about having different location for your funds in case you need to draw before age 60 so that you're not hit with those penalties.
Mm-hmm. Yeah, very good. It's valuable advice. So it looks like our questions are winding down. Let me just bring you back here. So, there is more information that you can, probe your questions, find answers. We have an application under fidelity.com/spire, and it's the type of application that you can use on your phone to continue your financial literacy, be able to open up accounts, be able to do budgeting and savings. We also have a whole host of articles, videos, different types of tools, simple ways to take action in any category. And you can follow at Fidelity for updates and find us on Instagram and Facebook. Okay, so a lot of interesting information that's available to you out there. I want to thank Monica and Lisbeth for helping me out. They are licensed reps and they're in the business of fielding these types of questions. I also want to thank Natalie for helping set this up. And behind the scenes, one of our colleagues, Travis Escobar, who coordinates community relations, he's always looking for opportunities to engage with Alpha and to bring more of these types of sessions for you. So like I said earlier, this was part of our 5 money musts. So we have 4 others that we can share at some point in the future.
Thank you very much for the presentation. I'm pretty sure the whole audience is as, I don't know, full of like context and insightful of like as I am. I really hope people not just like hear to you guys, but also start like putting this into practice, because I feel like that's the most important thing, to actually start like taking action. So thank you very much for all the information you share. And thank you very much for everyone who joined us today. We're totally looking forward, to keep going with this conversation. Please follow Fidelity for like more advice, reach out to our amazing speakers today, and also please stay tuned with Alpha Boston for like upcoming events as well. I'm going to be sharing the social media now channels that we have like in the chat.
And I also want to say one more thing. I'll speak on behalf of Geode, but Geode is hiring. Okay, so I am based in Boston and we are looking for people. And Alpha has a lot of talented people, and it would be my pleasure to hear from you all.
Awesome. Thank you very much for sharing that. So, you know, beside all the information, maybe there are new jobs available out there. So please make sure to reach out. Thank you very much one more time. And we look forward to keep going this conversation with you guys.
Thank you.
Thank
Muchas
you.
gracias.
Thank you for having us.
Yes,
Bye. Have a good one.